The Federal Reserve has a dual mandate for monetary policy. Maximum employment, which means economic growth, job creation, that's one part of the dual mandate. The other part, price stability, means low inflation, keeping the value of the currency more or less stable. Those both very important. Basically, in the medium to long term, there's really no conflict between those two goals. Keeping inflation low and stable is good for the economy and helps it grow and therefore helps create jobs. Over very short periods of time, sometimes we have to decide, how much rocket fuel do we need to put into the system? Do we need to create more acceleration to help the economy grow and to create jobs? If so, does that create additional risk of inflation? Or do we want to restrain the economy, hold it back in order to avoid inflation and maybe have slower job creation for a period? That's a difficult trade-off that we sometimes face in the short term, and we have to make judgments based on our forecasts about how to balance those two objectives in the short run. But again, that's a short run consideration. Again, over the medium to long term, the best thing we can do for maintaining economic growth and job creation is to make sure that inflation stays low and stable so people can trust the money of the United States and they can make decisions and plans about the future with the confidence that the money, the dollars they invest today will retain their value years in the future.